Hey everyone. In this video, we are going to apply what we learned in the previous one about individual decision making and just work through some examples so we can strengthen our intuition and our sort of how do we calculate all of these new concepts: accounting profit, economic profit, and marginal benefit and marginal cost. So let's start with the accounting versus the economic profit. And the main thing that you really need to take away is that we can think of our accounting profit as revenue minus explicit costs, and we can think of economic profit as essentially the accounting profit minus the implicit costs, essentially the opportunity cost of our time, of our resources, right? We're always thinking of what the next best thing we would have done with a particular item is. So as an example, I run a business. Let's say I earn $100,000 a year in revenue and my expenses are $50,000. So from the perspective of accounting, these are the two things that matter: money in and money out. And so in that way, our accounting profit would be all the money in minus all the money out. We would make on paper $50,000 a year. Excellent. But the thing we have to compare is what would have happened if I hadn't run that business? What would have been my next best option? And in this case, we're assuming that if I didn't, I would have earned $25 a year. Sorry, $25,000 a year. And so in that case, for our economic profit, we have to subtract that implicit cost. Now, this is the implicit cost of my time. What money would I have earned by doing something else? But there can also be an implicit cost of capital. If I'm using a storefront and I own that storefront, what did I give up by not renting it out to somebody else? If I'm putting money into my business, what would I have earned if I had kept that money in the bank and earned interest off of that money, right? So there's an implicit cost to really all of the resources that we put toward an action. So as a result, it's still profitable on an economic level for me to pursue this business. I'm $25,000 better off than if I had done my next best option, which would have been working in some other job. Now, you might think, if we're thinking just in a broad world, obviously we don't do everything for money, we do things for joy. And so essentially, if we were to try to extend this type of analysis, we would almost want to account for the kind of joy, either the joy we get in being an entrepreneur or the sort of negative stress we've incurred by being an entrepreneur and the joy we gave up as working with coworkers at a business. In order for that calculation to work, we would try to monetize that in some way, just so we can kind of keep all the units the same. But the idea is that when we're considering an accounting profit, we really just consider money going in and out. We consider economic profit, we're carrying those implicit costs. For the purposes of these examples and making things work, we're going to use those in financial terms, but we can apply these principles more broadly if we're willing to have other costs that reflect our own utility and values in there as well. So another way of saying that, you can't see because my head is in the way, but that our economic profit is equal to the accounting profit minus the implicit cost. So now let's work through George. So George has a business and he has two options. He could work as a CPA and earn money, certified public accountant. A lot of demand for CPAs these days, or he could work in his business. In both cases, he earns money. He gets CPA money or his business earns money. So if he works as a CPA, then his earnings are his wages. This is like his income. And the implicit cost is the foregone profits from his business. On the other hand, if he's a business owner, I'm writing here just because my head is blocking the thing. If he's a business owner, then he earns the profit from the business, and implicit costs are the foregone wages. So it's always about sort of the other option. Another way of saying this is that it doesn't really matter which way we set it up, we can calculate it from one choice to the other. So let's work through another example. We're supposing that we used to work as a lion tamer, and this earned us $45,000 a year, and we decide to open a tanning studio, and that earns $45,000 a year in profits, essentially after we pay for the costs. This is, we could call it the accounting profit. So what is our economic profit? Here, what we want to do is basically remember that our economic profit is just our accounting profit minus the implicit costs. I'm going to write AP minus implicit costs just to be a little short. So this is going to be 45,000 minus 45,000, which means his economic profit is 0. We could work this out properly. Another way you can think about it is that if he works as a lion tamer, he has $45,000 to take home. If he runs a tanning salon, $45,000 to take home. Essentially, it is economically equivalent. Now, from an accounting level, you would say that the studio yields you an accounting profit of $45,000. It's just that your next best option pays exactly the same. Now we've got another example with Sandy. This is a little bit more complicated. I'll put some options over here so you can see the other choices. C is going to be 0 and D is going to be negative $150,000. Again, head is in the way. So Sandy owns a firm and it has an annual revenue of $1 million. But she spends $900,000 on her other costs. Essentially, her profit is $100,000, 10% profit margin. That's not bad. But if she wasn't an entrepreneur running this firm, she could instead go get a job that has an annual salary of $250,000 because she has a lot of skills that are valuable to other companies, having run this very large firm with $1 million annual revenue. We're assuming here that her job would be as satisfying to her as being an entrepreneur. Again, we're kind of setting aside really this question of utility to focus on these costs. So the first thing is, what is her economic profit and what is her accounting profit? We're going to start with the accounting profit because, again, it's a little bit more straightforward. So accounting profit is going to be all the revenue, 1 million, minus all the costs. And this is going to be 100K. So her firm is very profitable, right? She's done very well. Now her economic profit is going to be the revenue minus the cost minus the implicit cost. So this is going to be the 1 million minus the 900,000 minus, oops, we need a 1 there, minus 250,000. This is what she's giving up by not working in her next best job. And so here, this was the accounting profit. This is 100,000 minus 250,000. And so this means that her economic profit is actually $150,000. So she's actually, you can't see it down here, but our answer here is going to be negative $150,000. That's going to be her economic profit because her business doesn't cover her salary that she would have otherwise earned had she been working in a job instead of running her business. Now for this example, we're going to walk through marginal benefit and marginal cost and how to calculate them and how they relate to profit maximization. So what we've put here is a little table or schedule for Joe and his business. I apologize, the resolution's not fantastic, so I'm just going to kind of write next to it. So total cost, marginal cost, total benefit, marginal benefit. All right, and one thing we want to note, remember, which I'm just going to kind of put in the corner so we have it in mind, is that our marginal benefit is going to be equal to the change in total benefit over the change in quantity. That is, how much additional benefit do I get when I produce one more unit? And then my marginal cost is going to be the change in the total cost over the change in quantity. How much additional cost I have to spend when I go up by 1 unit in quantity. So with these definitions in mind, we can figure out all the different blanks in this schedule. Now, intuitively, if I'm selling something, the marginal benefit is going to be sort of the revenue from that next additional item. If I'm selling t-shirts, the marginal benefit of the 4th shirt is literally the price of that 4th shirt. The cost is going to be how much it cost me to make a 4th shirt relative to making a 3rd shirt. And so that's what the concepts here are. Now, this is one way of presenting this in a table. It's not my favorite, but it's something that Krugman and Wells like, and I think they like it because it highlights the jump, right? So here, Joe's total cost is 100 when he produces 0 units. When he produces 110, when he produces 1, his total cost is 110. So as he goes from 100 to 110, his marginal cost is $10. Now, if he goes from 110 to 118, his marginal cost is $8 because that's how much it goes up. So the positioning here really highlights that that's the jump. So we can also write this in a different way. I can put my quantity here, my total cost, and my marginal cost. And I can say that at 0 units, my total cost is 100. At 1 unit, my total cost is 110. And so then I would put my marginal cost just right next to the first unit, like this. All right, so I just kind of make these like in a line. That just highlights that the 10 is from going from 0 to 1, the 8 is from going to 1 to 2. Either way is fine, whatever helps you remember what you're working with. All right, so let's return to figuring out what the total cost is of 4 units. So as we walk through, now we have 118. The marginal cost of the third unit, going from 2 to 3, is 7. When we add those things together, we get 125. Then the marginal cost is 10, so we get 135. Now we're at the fourth unit, so the total cost is 135. The next question is then, what is the profit maximizing number of units? And we've got some choices here, focusing on 2, 3, and 4. Now the key thing we want to remember is that when we're profit maximizing, to profit maximize, we need to set the marginal benefit equal to the marginal cost. So marginal benefit equals to the marginal cost. Now, sometimes when you work through these problems, they won't meet exactly. This is another situation where we get some imprecision because things are discrete. That is, sometimes the point at which these might meet would be if Joe provided 2.75 units of services, right? And that's not something we can realistically do. So when we don't actually achieve that, we're basically going to get as close as possible as we can without going over. So we're going to never produce where the marginal cost is greater than the marginal benefit. We're going to get as close as possible without going over. The intuition here is that on that final unit, if the marginal cost is greater, you've lost money on that unit, so you don't want to produce it. You want to walk back 1 unit. So we're going to do this or get as close as possible. So let's fill in these marginal costs again. So as before, this was 10, this was 8, this is 7, this is 10. Remember, this is 135. This was 125. Now we have to go up by something to get to 150, so that's 15. Then it's 20. And then this is 170, right? So the marginal costs are the things that we care about. And the marginal benefit we can calculate as the difference from going from 0 to 200, then 30, then 15, which brings us to 245. Now we go from 245 to 255, 255 to 8, 15, and 5. All right. So there's a few points at which these are equal. So for example, here, the first one brings me 200 units. The second is 10. So that's good. Definitely want to do that. The next is 30 versus 8. That's great. Making a lot of money on that one. The next is 15 and then 7. That's pretty good. And the next is 10 and 10. And so this is where they're equal. So that indicates me the optimal point. Now notice, because we're kind of in between, like what does that mean? This is the cost that was incurred from going to the fourth unit, and the benefit occurred from going to the fourth unit. So that means that the fourth unit is going to be our profit maximizing. Why not the fifth? So the fifth unit cost me 15, but brings in 8. So that means I'm losing 7 on this unit. The other way you can do this, if you're feeling unsure, is you can always calculate the difference between total benefit minus total cost and just write them down. So here, a cost of 100, this is negative 100. I'd call this kind of a brute force method. So here's 200 minus 110, that's 90. 230 minus 118, that's 112. 245 minus 125, that's 120. 255 minus 135, that's 120. And then 150 minus 263 minus 150, that's going to be 113, right? So you can see that the profits are going up and then they're leveling off and coming down. Now you'll also see, if you do this method, there's at one point, there's kind of a tie. If we see a tie here, then we want to always pick the bigger number. And that's consistent with here, going to the point at which marginal benefit equals marginal cost. That is, if we're indifferent, we're just going to pick the bigger one. So that's how we work with a profit like that. Then if we want to know what our maximum profit is, we can go back here and we can find, the maximum profit, we've already calculated it, is 120. So we don't need to do any extra work because we already did that. Now for this last example, we're going to do the same thing, trying to find the optimum quantity to produce based on the principle that we profit maximize when marginal benefit equals marginal cost, and remembering that if they're never quite equal, we want to get as close as we can without going over. So never marginal cost greater than marginal benefit. We never want to do this. Sad times. Okay, so a question like this, we're serving ice cream. We can serve 100, 200, 300, 400. Now, obviously, in real life, you can serve 175, 183. We've kind of forced a discreteness in here. For these types of problems in this type of world, we're not going to try to average between the two if that ever comes up. We're just going to stick with the possibilities that are here. Essentially, you could think of this in the ice cream world as maybe you only make batches of 100 because that's the way your equipment is set up. That would be an example. All right. So I'm going to do the brute force, and then I'm going to do the proper way. So the brute force way is going to take the total benefits minus the total costs and just pick the biggest one. So here it's negative 400. Here it's 350 because we're taking 800 minus 400. Here it's 400. Here it's 400. And here it's 375, right? So again, we have this tie. When we have this tie, we're going to pick the biggest number, 300. Now, the other way we can do this that's a little bit, can be easier, can be more difficult. It depends how many options there are, is we can calculate the marginal cost. So there's no marginal cost at zero. It's kind of going from negative, we don't have negative produce. So there's no negative marginal cost here, and there's no marginal benefit because we can't change off of zero. So here what we've done is we've gone from 0 to 100, and we've gone from 400 to 450. Now, one thing to note here is that this is not a 1 unit increase. And we're going to remember that the marginal cost is going to be the change in total cost over the change in quantity. So for example, here, for the cost on that first one, it's going to be 450 minus 400 over 100 minus 0. Our total costs have gone up by 50. And the total quantity has gone up by 100. So essentially the marginal cost here is 0.5. All right, now here, if you notice, this is actually the same, 0.5, because we've gone up by 50 and we've increased 100. And this is actually completely flat. So it's just 50, 50, 50, 50. Now the marginal benefit is going to be the same idea. It's going to be the change in total benefit over the change in quantity. And so that's going to be, for the first change, going from here to here, it's going to be 800 minus 0 over 100 minus 0. So that's going to be 8. That's great. Now for the next one, I'm going up by 100. I'm increasing by 100. So this is going to be 1. Now I'm going up by 50, going up by 100, so that's going to be 0.5. And then here I'm going up by 25 and going up by 100, so that's going to be 0.25. So using this method, we can see that this is where they're equal, and so we're going to get the same answer as before. Now, one thing that gets a little bit complicated is that when we're thinking about profits, we're thinking about the benefits versus the costs, right? We want the benefits to be as big as possible and the costs to be as small as possible. And so we're trying to maximize the difference. Now, that doesn't mean we're maximizing the difference between the marginal benefit and the marginal cost. We're maximizing the difference between the total benefit and the total cost. That's what the brute force method does. What we're doing is setting the marginal costs. So we don't need those to be a big gap. We want those to be equal because it means that essentially we've taken advantage of every opportunity to produce so long as the marginal benefit exceeds the marginal cost, and we're stopping once that ends. Again, just to highlight a few pitfalls or just potential complications that have come up. If they're never exactly equal, then go down 1 unit, but never ever produce when the marginal cost is greater than the marginal benefit. So you may get really close, but never go over. And then if there are two values with the same profits, you can either use our standard, set the marginal cost equal to marginal benefit, and there'll be a clear winner. This is what happened in the previous examples. But then if you've already profit maximized, then pick the biggest amount in order to, you can't see this here, revenue maximize. And that will also get you to the right answer. we'll stop here, and then you can keep practicing in the homework and other assignments.